these banks and investors reassessing their risk appetite in light of a new monetary policy regime in Europe and in light of what happened with Credit Suisse and concern that the banks are going to fail, that there's going to be a global financial crisis, things of that nature.
Hey guys, it's Foss. I want to make sure that people understand the correlation between credit default swaps and equities is very clear, because when you are a seller of protection, i.e., you've sold insurance against a default on any entity, but let's take a bank, that seller of protection can turn around and buy put options or conversely short on a delta weighted basis the equity of the same institution and thereby protect the insurance that they have just sold, right? So let's make sure that we understand that in capital structure arbitrage, there's many ways to hedge the selling of insurance on a bank. You could sell insurance on Deutsche Bank and turn around and buy protection on another bank, and that's sort of a pairs trade. Or you can do capital structure arbitrage where you short the subordinate equity. And that's why it becomes such a death spiral when you get things like jump to default insurance on 1 year versus 5 year CDS, and guys purchasing deep out of the money options, put options on the stock. All of this translates into increased volatility, increased risk, and a risk appetite that leaves the stage. Okay, so the credit default swap traders run the world. They always have since 2008, 2009. If you don't understand how credit default swaps work, you really shouldn't be trading equities in any institution that has leverage, which is to say, every single bank institution is being now traded by credit default swap traders, and the contagion risk is huge. So I love the comment earlier about cocoa bonds and how this alternative tier one source of capital got totally upended in the priorities of claims process. This has just taken a ton of confidence out of the system because you have just rewritten the rules of finance when $17 billion of debt can get zeroed and there's still a $3 billion equity rescue. I mean, this is just rewriting the rules of finance, and people are rightfully concerned. So watch CDS. It will always smell the rat before equities, and the poor equity guys are holding the bag. They're getting used as a punching bag because the CDS guys are using them to hedge against the risk and the protection that they're selling. It's just a very fluid game and controlled by the big boys with ISDAs and everything. It's the poor little guy gets used as a they beat him like a rented mule. That's the way it works.
Right. Also, the
I think it's
markets are not that
so,
liquid, right? CDS market is not liquid
Wrong,
compared to the equity
wrong,
market.
wrong, wrong. It is far more liquid than the equity market, and it's far bigger.
That's actually not true. You can, by the way, it's supporting of your point. If you really want to move the markets, you attack the CDS spreads, and the
How
cocoa
much
bonds.
CDS have you traded in your life? Because that is not
Last time I
true.
traded that was around 10 years
Okay,
ago.
see, then you're absolutely not talking with current.
Go ahead, tell me what are the volumes, and let's compare it to the equities.
You
Name it.
okay? Very simply, it's.
Go ahead.
Do you have the volumes of CDS?
No, I can look it up right now. But
You actually
go ahead.
can't look it up. So there you go. You see, that's the problem. You can't look it up. Now, the appearance of equity being liquid versus the appearance of CDS. Yes, CDS can gap, but the size it gaps on is on big size trades, not on little incremental trades. Okay, so you got to be real careful about the appearance of liquidity versus true liquidity.
I think it's worth underscoring the point about the AT1 bonds. I mean, that has shaken a lot of confidence. It's made, I think, people kind of feel like they don't really understand the kind of deep nuance and deep plumbing of the system. Um, you have Swiss financial regulators, defending the decision again yesterday afternoon, and that I think is contributing to this general reassessment. How much risk do we want to have? How much risk are we comfortable with? And that risk assessment is, I think, playing a big role, obviously, in what's happening in credit default swap markets, big role in what's happening with the stock prices of these banks. But again, I just want to underscore a second time, there's a lot of room between a reevaluation of stock prices and a lot of room between changes in credit default swap yields and Deutsche Bank failing and some sort of cascading domino failure of major
Well,
banks.
Michael, that's well said. Here's the truth, okay? The reality is that this restructuring of the pecking order has caused a tremendous amount of consternation in the credit markets. And those AT1s, which are plumbing new lows, have a cascade effect into other parts of the capital structure, right? If you own an AT1 bond and you run out and buy protection on on Deutsche Bank because those bonds are plumbing new lows. You buy protection to protect your AT1 position. What does the guy who sells the protection do? He runs into the equity markets and either short sells the Deutsche Bank equity or lays off the risk with another seller, a hedge fund who wants to close out a position. But at the end of the day, it's all circular and you're pushing on a string. And that's what's so important.
Yeah, I think that's well said, and it's exactly how I'm thinking about it.
Data point, jump in.
Yeah, I mean, at least on the idea of cocos, I mean, how much of that do you think as well, the fact that, I mean, most of these are perpetual cocos, right? And I think almost all perpetual cocos have been called on their first call date thus far, right? I mean, necessarily banks don't have to exercise their call options, and obviously if they don't, the issuer just chooses not to redeem its bonds. It does to some extent force investors to reinvest based on the prevailing rate environment and risk-free yield. But some of these, like I think the perpetuals for Deutsche were issued at what 750 basis points, and they're now I think upwards of 20. So I mean, I think that there's a lot of things that kind of feed into this. I mean, obviously, if we're looking at what's happening with perpetual cocoa bonds, the underlying credit profile of Deutsche is obviously shifting, and I think that obviously, just as a function of how that operates, that's actually front run the blowout in CDSs. I mean, if you were looking at perpetual cocoa bonds, 2 weeks ago, they started to gap out and widen well before credit default swaps did, right? So, I mean,
They're a gimmick,
I
though.
think.
They're a gimmick. It's an accounting gimmick. Think about it. It's used as alternative tier one capital so they don't have to raise equity. It was issued at a time when interest rates were so low that the reach for yield caused investors to put at risk a bond instrument to create a yield when in fact it should have been equity. And that's the problem with the BIS guidelines. Reverse engineering true economic risk and plugging it with these bullshit fucking AT1 bonds where people get zeroed out. And then there's $275 billion of AT1 bonds in the world where people over the weekend just said, oh my risk is not what I thought it was. The CS restructuring just zeroed out 17 billion of it and rescued some residual amount of equity. That is the problem. Reverse engineered BIS guidelines sold to fools. If you bought AT1 bonds as a perpetual, you're an idiot. And I'm afraid there's a ton of idiots out there, including PIMCO, that lost $800 million. It's a gimmick. It's an
Yeah,
accounting gimmick.
Foss, I don't disagree with you, but the problem is if we look at pension funds or if we look at banks in Europe, I mean, all of these guys were holding these perpetual cocos, right? Because they outperformed bank equity, like European bank stocks, by a massive margin. I mean, essentially since 2012. So, I mean, I think the systemic risk of this issue is absolutely fucking massive, right? Like this is.
Absolutely massive. Well said, sir. Absolutely massive.
So, question for Foss, and generally curious. I'm looking at the timeline. Everything began to plummet when Deutsche announced the redemption of the Tier 2 bonds. Why do you think that happened? That's weird.
I'm not aware of that timeline, and I would just say this. I mean, CDS has been forecasting the downfall of Credit Suisse for over 2 years. Okay. And the same thing can be said with any other GSIB. that has a $1 trillion asset base and less than $60 million, 60 billion of market cap of equity. It's just over levered to the true economic risk. So I'm not really sure what snowflake causes the avalanche, but any snowflake can cause the avalanche at any time, right?
Yeah, and I think it's important not to generalize from Credit Suisse. I mean that bank has been the problem child of European banks for over a
Deutsche
decade,
Bank is just as
and
bad. If you run the math on their derivatives book and everything, Deutsche Bank, in fact, is more highly levered to economic risk than Credit Suisse was. Just the facts.
And
that
just for the record, Greg has been saying that on every Spaces that we've been on, even
It's
before
true.
Credit Suisse has issues. I mean, I've obviously, like, I brought Greg onto a Spaces a few weeks ago, and he said Credit Suisse will be next. That was before any of this, and Deutsche Bank will follow.
yeah, and
So
my
just for the record,
and
this is not like new, hindsight perspective from Greg.
for sure, and my only point is, again, try to stay focused on the macro picture. That I think it's important not to generalize from Credit Suisse, not to generalize. We don't know what's happening with Deutsche Bank yet, but certainly not to generalize from Credit Suisse to any sort of broader statement about the systemic situation of European
But
banks.
fair enough. But banking is banking, right? Canadian banks are 20 times levered to their risk. When you're 20 times levered, in the case of European banks, 33 times levered. But leverage at 20 times is not even healthy either. But that's the business of banking. That's all I'm pointing out. And this is why people do not understand banking properly. And they don't understand the difference between credit risk and being capitalized for credit risk and interest rate risk and mismatching your assets and liabilities and what that can do to blow a hole in your book value of equity, right? So it's, look, guys, I don't
Yeah,
want it to happen. I do not want the financial system to collapse, but when you have greater than 20 times leverage, it's prone to collapse. It's there. That is the problem.
So, Foss, real quick, one question. Given and Dear Point, I saw you had your hand up, so you can go right after I get this answer. Anyone can take this. Given the fact that, there's this dollar shortage in Europe, right? The ECB doesn't have the ability to print dollars and siphon it to these banks. What are the implications of Germany's largest bank, right, Deutsche Bank, going under and actually defaulting on its counterparties? And what intervention do you think we'll see? Do you think it'll be a Credit Suisse style sort of leverage buyout where the European Central Bank sweetens the pot for another bank to buy Deutsche Bank? What do you think the fallout is from this, and what sort of intervention do you think that we'll see, Foss?
Oh man, I mean, look, all I will say is Deutsche Bank. Who would buy Deutsche Bank? Firstly, who's big enough, and secondly, who would want them? Much like maybe UBS is saying, "Yeah, I thought I got a good deal on this toxic CS stuff, but maybe not," because right now, my opinion is UBS is woefully undercapitalized to the true economic risk as well. But I'm not an ambulance chaser, guys. I do not want this to implode. Again, I am just telling you the mathematics of it is very simple. Right now, run what the book value of equities versus market cap of equities are for a lot of these banks, and you will see very clearly that they are woefully undercapitalized to their true economic risks, which is to say, if their loan book changes by 2%, they are vaporized. The equity is vaporized. 2%, guys. That's the equivalent of a bond going from par down to 98 cents on the dollar due to credit spreads. Do you think that doesn't happen on a regular basis? Like, it's just so undercapitalized to its true credit risks. And that is the next shoe to fall. I suggest people look at commercial real estate exposure across the system everywhere. Again, I'm not an ambulance chaser. I'm just doing the mathematics on a leveraged system. So, Joe, I don't know the answer. I would just say this: be careful, because Deutsche Bank only has a market cap of 20 billion on trillions of dollars of balance sheet risk and off balance sheet risk.
So can I just address a few things just here on the question just posed? So in terms of dollar liquidity, a lot of people were wondering where the $60 billion that was tapped out from foreign banks from the swap lines at the Fed in the discount window, because people thought, okay, well, after UBS bought Credit Suisse, why would that continue? So that could be quite a bit from Deutsche Bank and a few other banks. I do think the Fed will be there with the liquidity and the swap lines. in order to support dollar needs. On Deutsche Bank, I'm trying to understand the timeline why there was a sudden spike in the CDS, because I just see here. So in the morning they redeem tier 2 bonds, right, the 28s. Those were trading at like 86 cents in the distressed times about a week and a half ago, and they settled sort of recently in the 93, 92, 94 range, and now they redeemed them, okay, close to par. And I see that the other bonds didn't really rally as much as expected. And so probably the second derivative move was to say, okay, what are they going to be able to redeem all the bonds? They're not going to be. And there was still stress in the bonds, and hence the CDS spread
Well,
spiked.
let
And then we got this.
okay,
That's
so
the
great.
timeline
This
that I
is
see here.
interesting. Okay, I'll just play it because I'm not in that chair trading that right now. But imagine that you had shorted the bonds. Okay, so you had shorted the bonds and you had a negative credit position. So, meaning you were anticipating the bonds to go lower in price. What you could have done then is gone out and sold protection as well. Okay. And the reality is that dynamic, when you get called on one leg of your trade, meaning I thought these bonds were going to trade at 86 cents and I had shorted them and wanted to cover them down at 75 cents, but the market or the bank comes in and rug pulls me and they pay me off at par. There is an unmatched liability on the other side that can cause a cascading effect across jump to default versus 5-year CDS and all this. It's a very now it's not a science, it's more of an art. Like, you're hedged and wedged, okay? You have all these open risks that now have to be rebalanced because the bank came in and retired this for cash, and this is very key. They retired them for cash at 100 cents on the dollar. So that leaves a lot of hedged and wedged positions to cover or to go back into the market and reallocate risk, if you will. I'm throwing that out there. I was not trading the position.
No, that makes sense. But it's ironic that they did this move to put confidence in the market, and all hell broke loose.
I
I mean,
think
it's
it's
just
deeper
weird.
too. I really think it's more to their AT1 bonds and more to the Credit Suisse decision to zero out 17 billion of a security that had been highly relied upon to bring more capital to the banking system. That's my 2 cents. I'll just say this, guys. I'm going to drop down. It's interesting to talk to you guys because the solution, we all know, is more printing, more quantitative easing. If you look at the Fed's balance sheet, they have reversed quantitative tightening,
Absolutely.
and that is the only solution. It's more money to print and to solve the debt spiral that gets continually kicked upstairs. So the financial system kicks risk up to the sovereign debt level, and the central banks issue more debt and more quantitative easing to solve the fiat debt spiral. That's the mathematics of it. Don't overthink it. Leverage begets more leverage, and they kick it one stage higher all the time. And the last place they can kick it to is the sovereign debt level. So watch Deutsche Bank CDS, but I'll give you a little tip here. Watch Deutsche Bank CDS and then watch CDS on Germany. And then watch CDS on the USA. And then say, holy moly, we have a problem, Houston. You better get protection against the debasement of the fiat currency because that is 100% certainty. Thanks for having me, Mario. I got to jump.
So it's not actually QE. What's happening is that you have
It's
banks using the
QE. It's
discount
QE,
window.
Jay. I love you.
Hey,
It's QE.
wait for me to
Good
finish.
day, guys. I got to jump, but it is QE.
Um, so what's
He's not.
happening is they're using the discount window, and they are pledging securities at a haircut. And they're now there's a discount window and there's a new facility. At the new facility, they're pledging the securities at 100. They're getting 4.7%, rate, and they're being charged in many cases, like FRC, they're being charged more than they earn on their assets. So the cost of borrowing is so high that it is going to be destroying NIM at a lot of these banks. And what that means is that one, they need to raise equity, they need to raise capital to fix their balance sheets. Two, they need to raise the costs on their own deposit because of deposit beta to attract their depositors back. And who knows how easy that is going to be, and you're going to have some banks that are going to fail. And then three, you have to give that money back, and that money isn't being used to lend to people. It isn't going back to the bank, and they're not buying securities with it. That money is spoken for